Hey guys, this is a market update. Crypto is flying this week despite the Fed trying to absolutely destroy all markets once more. Why is that? What is crypto pricing in right now? I'm going to go through that in this video. And if you're a long-term investor, the latter part of this video is for you because there is an incredible chart showing that we are right on schedule for Bitcoin, but altcoins are outperforming right now. And so I want to go through that as well and some of the reasons for this. So crypto is pricing in right now essentially zero inflation going forward. Even though the Fed came out this week and said the job isn't done, terminal rates of interest rates are going to be higher than everyone expects. And so everyone was kind of running around in panic there. The stock market sold off, but crypto didn't. So why is that? Looking at the Bitcoin price, this is it right here, consolidating and even moving higher. Like I've said before, we are not going to the moon anytime soon, in my opinion, for a few different reasons. However, this is the accumulation zone for me. So this is still not a really bullish chart, right? We're just consolidating right here. Now we've got CPI coming out, I think, on the 14th of November. This is pretty big, and this is coming before the midterms, and so it's a very big number for the markets, right? If it comes in very light and we can see CPI coming down, then the market's going to go to the moon, right? And the reason is because we're seeing the market, the economy really fall off right now. And I've got another chart to show you why you should not wait for the economic figures to get really bad before investing. So we're just seeing a consolidation here for Bitcoin. I think it's a really healthy price action, and I'm happy to accumulate here. I don't think we're going to the moon though. As you can see, we're still really making lower highs. Even though this is a consolidation, it is a lower high. And so I'm very comfortable at this level. You can see the support down here is really strong at like 18,000, and we are consolidating actually at this level, which is getting way more touches, as you can see here. So again, I think the market is just calm right now. I think there's a balance between, a lot of selling from some Bitcoin miners that are capitulating, but you've got other traders also trying to price in basically a lower interest rate environment despite what the Fed says. So we'll look at that now. If you are a trader as well, get your deposit bonus on BitGet. They're giving up to $8,000 worth of deposit bonus in your future trading accounts. So if you trade, get that deposit bonus. Also, if you trade spot, they're giving free spot trades across all spot pairs right now, which is a good bonus. So check that via the link in the description. But the reason why the Fed was so hawkish this week is because of this right here. This is the 5-year break-evens chart, which is essentially the market's anticipation of inflation going forward. And you can see it was really rising. This essentially it means that financial conditions are easing a lot. And that's not what the Fed wants, right? They want everyone to remain kind of bearish and hawkish and not for the stock market to rise and everything like that. So it's really important not to take the Fed on their word, because what they say is what they want to happen. But as an investor, you have to look 6 to 12 months out at least to what's going on if you're trading. Now, if you're investing, that's totally different. Just choose the best assets, right? But what the Fed are saying is, hey, the market's getting way ahead of us and we still got this job to do. So we don't want you to go up and we don't want you to ease. That's what they're saying, right? They did that by saying, Jerome Powell said that by saying, we think the terminal rate is going to be higher than everyone expected. I don't think that. I think he's just saying that to get inflation expectations down for the short term. As soon as the economic figures come in really bad, and they are starting to do that, then they will have a different job on their hands and they will start to completely change their rhetoric. Very important that what they say is not what to invest on. You have to understand what they want to happen, but what's actually happening in the markets. Now, what he wanted to happen was the inflation expectations to come down, and they are coming down. Remember, this has a lag to the real world as well and to CPI. So CPI is going to be coming out. It could even remain quite high, but the market is not pricing that in anymore. It's pricing in the future, which is to the downside for inflation, and these figures also point this out. There are layoffs everywhere right now, and that's exactly what the Fed wants. So Robinhood slowing hiring, Apple freezes all hiring, Stripe, the payment processor, are laying off 14% of their staff, Lyft 13%, Twitter, Elon's going to get in there with the hammer, I'm sure. Intel said they would cut positions, although we don't know how many. Dapper Labs, who make NBA hotshots, 12% of their staff. Galaxy Digital, which is a crypto company, 20% of staff. Amazon are freezing all hiring. Microsoft, Alphabet, all freezing or slowing the pace. Crypto.com laying off 30 to 40% of their staff. That's what the Fed wants, and none of that will be in the jobs figures and CPI figures that are always backwards looking. But we have to invest for the future. And if that's the environment and jobs are getting really thin and the job market more competitive, then rates don't need to be this high. Also, a dichotomy here from the Bank of England and the Fed. The Fed saying, we think terminal interest rate is going to be much higher than everyone expects. The Bank of England raised 75 basis points, but in the same meeting said weaker growth momentum and a more conservative fiscal policy is expected to ease pressure for more aggressive monetary tightening. The Bank of England governor, and they never ever talk about market rates because that's not their job, but they did in this instance because of what's been happening in England and the UK. They said that they think the market rate for gilts that they're trading at is higher than they should be. And they never say that. The reason is because they see an absolutely horrific picture for growth going forward. And so they are saying, now the reason gilts are selling off and a very high yield is because everyone thought the UK was going to blow up. The Bank of England stepped in by printing more money, as is the solution to everything, apparently. And so they averted that, and now they're saying interest rates are too high. Now, if Europe is absolutely cratering, then the world is cratering as well. It's a big economy and it feeds into the States. Look what happened out of Germany today. Industrial orders, the economic powerhouse of Europe, month over month, actual, minus 4%. And the previous was minus 2.4, and the forecast was for minus 0.5. Markets go up on this news as a reaction because weaker economic data means lower interest rates, and that just feeds through to higher risk asset prices. And so you'll see crypto potentially find a level and bounce off of this because traders price in lower rates going forward. Remember, Bitcoin trades off of interest rates and money supply, not on earnings or anything like that. It obviously has correlation to the stock market, but the algos will trade economic weakness with something like Bitcoin actually going up because yield expectations come down. Now, for long-term investors, if you're trading Bitcoin and crypto, why you shouldn't wait for really bad economic data to invest. And we went through this in another video. Essentially, what you can see here is that through every recession, the stock market will actually start rising before the worst of the economic data comes out. And there's a reason for that. It's because usually the Fed will actually just stop hiking rates, right? Most recessions are caused by a Fed rate hike cycle that they need to get inflation down. And so once they see that coming down, then they flip again. All of the data takes a long way to feed through, but the stock market prices things in instantly. Remember, stocks and crypto will be pricing in things in 6 to 12 months time. So what's the arena going to look like? Well, in 6 to 12 months, we're probably not looking at any more inflation. At least it won't be going up or staying the same, right? It'll be starting to come down. Whether it's at 2%, which is what they want, obviously that's unknown. But as we can see here, this blue dotted line, in most recessions, and it's difficult to compare because none of these situations are the same, but the reaction of economic data and asset prices does remain the same. Every single recession that comes, you get a bottom and then a bounce in the stock market before all of the economic data bottoms. The economic data bottoms anywhere from like 3 maybe to 4, 6 months later. It really depends. You can see here. So obviously the crisis here, the recent crisis, is a bit different because that was a pandemic. So but you can see earnings coming way down, but the stock market going up because interest rates are coming down and money printing here. You can see the GFC as well. The stock market absolutely crashed, right? It was awful, but then it recovered, and you see GDP actually still going down. You see payrolls, that's the jobs, still coming down, earnings still coming down, and then rising after. So if you're waiting for earnings and payrolls to actually be getting better, you've already missed the bottom and a really good move up. And so that's why I think it's really important, to understand that you're just going to have to take some risk if you're trying to buy crypto right now and Bitcoin. You're going to have to take some risk that there may be another potential down leg, because the risk is that it's going to be up if you're waiting, and so you miss that move. And so you either dollar cost average or you just take the risk if you're trading over a 6 to 12 month time frame. Now this is for long-term investors. As you can see, essentially there are 3 buy zones in the past few years that have been absolutely worldy opportunities, right? And it's when the cost basis, the realized price, is below the long-term holder realized price. So the orange line here is the realized price. That blue line, whenever the orange is under the blue line, that's been this huge buying opportunity, showing market bottoms, right? And now you can see this isn't like a 2-week or even a month thing. In 2015, it lasted for 17 months, right? An absolutely horrific bear market, but turned out to be the absolute best time to dollar cost average during this cycle right here. Now in Jan 2019 to July, you have an 8-month period where you're below the long-term holder realized price, and again, an absolutely fantastic opportunity to dollar cost average during that time. And then that actually would have probably been a great move, but then we had the pandemic right here, which forced us lower, but for no period of time. We're in it again. Now, I'll get myself out the way. What you can see is that we're in it for 3.5 months right now. So it's not like the end right here. This lasted for 17, then you had a halving here of up to, say 8 months, which is about half, and we're at 3.5 months now. So is that 4 months? Is that 6 months? For a long-term investor, it doesn't matter. This is the dollar cost average zone. There's just nothing else to look at. If you're not dollar cost averaging here, when on earth are you doing it? The other time potentially to trade or to dollar cost average is actually on the upswing. So you actually wait for the realized price to actually break back again through the long-term holder realized price. And that suggests potentially that you're now coming out of that accumulation zone into a potential move up. It just so happens that these also correspond really well with the halvings as well for Bitcoin. And if we were to have a normal cycle, what you would expect is that 2023, like mid 2023 or early 2023, that's when the up move in the price is going to start happening in anticipation of the next halving in 2024. If you put the halvings on here, you actually start moving up way before that, about 12 months before the halving. And so all of this matches out pretty well. Are we going to stay in this for, 3.5 months, 4 months, 6, 8 months? If you're a long-term investor that wants to hold like 5 years or more, it's irrelevant. This is the dollar cost average zone. As you can see, just have to dollar cost average here and wait. You're always taking risk that it might go down further, but that is investing. Yes, the Fed is remaining hawkish in their rhetoric. Yes, stock prices could come down a little further with earnings, but we're seeing job losses accelerate, and we're seeing economic figures out of Europe get really poor. That means that a recession, we're basically in it or very soon in it. And so that means that inflation is not going to be a problem and it's going to start coming down. And if China starts to reopen next year after Chinese New Year, which it looks like they're starting to feed things out into the press to actually do that, then you're going to start to see things return back to normal and actually governments flip to trying to, support some sort of growth and stop a decline. And so that's what the market is trying to price in right now. It's not a 1 or 2 week thing. It could be a 6, 8 month thing, but it's right here, in my opinion, this kind of to and fro of trying to flip from that inflation fighting to now recession. So it's a very different environment we're going into. I'm very happy to accumulate crypto at these prices, even with potential risks. I just think it is the zone personally. If you want to get a deposit bonus on BitGet, if you're a trader, up to 8,000 in your futures trading account, free spot trades right there as well. So check the deposit bonuses and offers via that link in the description. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.